Hey everyone, and welcome back for another deep dive. Today, we're going to be talking about Regeneron Pharmaceuticals. They're a big player in the biotech space, and they just made this kind of surprising announcement that they're going to be offering a quarterly dividend.
Right?
And this is a big deal because it's making everyone wonder, is now the time to buy their stock? So we're going to be checking out this article from the Motley Fool to kind of break this all down for you.
Yeah, what's interesting is that their stock has actually been kind of lagging behind the market over the past year. But get this, their Q4 2024 earnings actually beat what everyone was expecting, and that caused their stock price to jump up like 5%.
Okay.
So now the big question is this new dividend a sign that they're strong and a good reason to invest, or is there maybe something else going on here?
Yeah, let's talk about this dividend because, what really stood out to me was that this is the first time ever that Regeneron is offering a dividend. And they came out swinging. They're offering $0.88 per share. That's a pretty big deal, isn't it?
Yeah, it definitely is, especially when you compare it to some of the bigger, more well-established pharmaceutical companies. Like if you think about Eli Lilly, Pfizer, Johnson & Johnson, they all offer dividends, but their yields are higher. But for a company that's never offered a dividend before, this is really competitive, even if you compare it to some of the tech companies that have started doing dividends recently, like Meta Platforms or Alphabet Regeneron's, is surprisingly high for their first time.
Yeah, and here's where I get a little bit skeptical. Does it really even matter how big that first dividend is if they can't actually keep paying it? At the end of the day, what we want as investors is a company that's going to pay us consistently and hopefully even grow those dividends over time.
You're absolutely right. The most important thing here is if they can sustain it. Can they keep making those payments? And that really comes down to two things. How healthy and profitable is their business? And are they actually committed to giving money back to their shareholders through dividends?
Right, and I know that Regeneron has had a couple bumps in the road lately. Their star medication for the eyes, Eylea, it's been facing some tough competition. And they've also been dealing with these things called biosimilar challenges.
Right.
And basically what that means is other companies are making copycat versions of the drug that are cheaper, and that's really cutting into their revenue. So could this affect their ability to keep paying this dividend?
Yeah, that's a totally fair question. But let's take a look at how they've been doing recently. In Q4 2024, their revenue actually went up 10% compared to the year before, and they brought in $3.79 billion. Wow. Even their Eylea sales actually increased a little bit, even with all that competition.
Okay, so they're showing that they can still hold their own, but what's behind these good results, even with all these challenges? Is this enough to make investors feel better about whether they can keep up with the dividend?
Well, the Motley Fool article actually points out three reasons why they think Regeneron's going to stay strong. The first one is they have this new version of Eylea called Eylea HD. It gives doctors more options for how often they give the treatment without being less effective. And it's already making up a good chunk of their Eylea sales.
So that new Eylea HD is really helping them stay competitive in the eye medication market.
Yeah, exactly.
Okay, that makes sense. What about the second reason for being optimistic? I'm thinking it might be their treatment for eczema and COPD, Dupixent. I keep hearing about that one everywhere.
Yeah, you got it. Dupixent is a real game changer for them. It just got approved for treating COPD, which is a huge market for them. Some analysts think that Dupixent could end up bringing in $20 billion a year.
Really?
Last year, it brought in $14.15 billion.
Wow, that's incredible. It seems like Dupixent could definitely make up for any losses they might have from Eylea. So what's the third reason that the article mentions?
Their pipeline of new treatments. Regeneron has been putting a lot of money into research and development, especially in cancer treatments. They have a ton of projects in different stages of development, which could lead to some major new drug approvals in the future. This kind of constant innovation is so important for any biotech company that wants to stay ahead of the game.
Right, so they're not just sitting around and relying on their current products. They're really working on developing new treatments, which is a good sign for their long-term growth. But how does this whole pipeline thing connect to their ability to keep paying this dividend?
That's where we have to look at their overall strategy for how they give back to shareholders. So the dividend's exciting and new, but we also have to remember that they have a pretty big share buyback program.
Ah, share buyback. So they're paying dividend and buying back their own stock. That's interesting. What does that mean?
Well, they just added another $3 billion to their buyback program, bringing the total to $4.5 billion. And their CEO, Leonard Schleifer, said pretty clearly that they see share buybacks as their main way of giving back to shareholders.
So it seems like they're focusing more on share buybacks. maybe even more than growing the dividend.
That's definitely an interesting approach.
What does that mean for investors who are interested in Regeneron mainly because of this new dividend?
That's a really good question. It might mean that even though they're paying dividends, the dividend might not grow as fast as some investors want.
So they're not getting rid of the dividend, but it might not be their top priority for giving value back to shareholders. That's really important information for anyone who's thinking about investing in Regeneron. But before we go any further with this strategy, let's just take a minute to recap what we've learned so far.
All right, so we've seen that Regeneron is testing the waters with this dividend for the first time, and it's a pretty strong start. And even though their Eylea medication is facing some competition, it seems like their business is doing okay. Eylea HD is gaining traction, Dupixent is doing even better than expected, and they've got a lot of promising new treatments in the pipeline. Exactly, and while that pipeline definitely points towards growth in the future, they seem to be focusing on giving back to shareholders, mainly through share buybacks. Not necessarily by increasing the dividends super fast anytime soon.
So they're kind of doing a bit of a balancing act here, offering a dividend, which is cool, but also really focusing on these share buybacks. But couldn't share buybacks be a little risky? I mean, I've heard people say that they can actually hurt a company if they're not done right. What makes Regeneron's approach different, and does it actually help us as potential investors?
That's a really good point. Share buybacks can be a double-edged sword. If a company buys back shares when their price is too high, it can actually end up hurting the shareholders who are already there. But if they buy back shares when the price is low, it can be a good way to increase the value of the shares that are left.
So it all comes down to whether Regeneron is buying back shares at the right price. But how can we as investors know if their strategy is a good one? Is there anything in their financials or their business plan that can give us a clue?
It's all about figuring out how much the company's actually worth and what their future looks like. If you look at how innovative Regeneron has been in the past, and their strong pipeline and how they've handled challenges before, it seems like they're in a good position to actually create value through these buybacks.
I see what you're saying. It sounds like they're confident that they're going to grow, and they think that their shares are actually undervalued right now. But I'm still a little hesitant. Wouldn't paying dividends be a stronger sign that they're committed to shareholder value for the long term? I mean, dividends are like a real reward, a clear way of showing that they're sharing their profits with investors.
You're right that dividends could be a really clear signal that a company is committed to its shareholders. But we can't forget that buybacks can also create value for shareholders. By buying back shares, they're reducing the total number of shares out there, which means each share that's left represents a bigger piece of the company, and that can lead to higher earnings per share, and maybe even a higher stock price.
Okay, I'm starting to understand their reasoning. It's like they're saying we believe in our potential for growth so much that we're going to invest in ourselves by buying back our own shares. And if they actually do grow, like they think those buybacks could be really valuable for long-term investors.
Exactly, and by focusing on buybacks now, they have the option to increase dividends later as they grow more. It's a strategic choice based on what they're focused on right now and how they see the future.
So it's not really about choosing dividends over buybacks. It's about figuring out the best way to give back to shareholders right now.
Exactly, and that's what this whole deep dive is about, helping you, the investor, understand all of these details so you can make good decisions. We're not telling you what to do. We just want to give you the knowledge and the insights so you can figure things out for yourself.
So let's sum it all up. Regeneron is getting into the dividend game with a pretty good offer. Their business seems solid, even though there are some challenges. And they're definitely committed to giving back to shareholders. But for now, their main way of doing that is through share buybacks, not by increasing the dividend really quickly.
And that brings us to the big question. Knowing all of this, how does this dividend announcement and their overall outlook make you feel about Regeneron's stock as an investment?
Would you want to do more research, maybe dig into their financials and see how much they're actually worth? Would you put them on your watch list, or are you thinking about looking at other investment options?
This is where your own thinking and your risk tolerance come into play. We've given you the info and the context, but the final decision is up to you.
That's right. This whole deep dive has been about giving you the tools you need to figure out this whole dividend announcement. We've looked at how the company is performing their strategy and what it all could mean for investors.
Remember, the best investors are the ones who do their own research, ask tough questions, and make decisions that fit their own investment goals.
And with that in mind, now it's your turn. We've given you the basics, but the real learning starts when you start digging deeper in yourself.
Think of this deep dive like a starting point. We've gone over the main points, but there's always more to find out. What parts of how Regeneron works or how they approach giving back to shareholders are you most curious about?
Maybe you want to learn more about their specific cancer treatment programs, or you could compare their dividend strategy to other biotech companies.
Whatever catches your attention, follow that lead. Look into their financials, read those analyst reports, compare their value to similar companies.
The cool thing about investing is that it's like a never-ending journey of learning and discovering. And the more you really engage with the info, the better you'll understand the companies you're thinking about investing in.
So get out there, explore, analyze, and most importantly, make smart choices that fit your goals and how much risk you're comfortable with.
And remember, we're always here to help you navigate the exciting world of finance and biotech. Until next time, happy investing.